Welcome to Woods of Stardon. This is CH. I will be covering the first Sentier Asian Quality Bond Fund in this video, which is part of my Absolutely Biased Comments or ABCs series. The aim of this series is to cover one fund per video to share how an individual investor can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. First Sentier Investors has its roots from First State Fund Managers, an asset management arm established in 1988 by the State Bank of New South Wales in Australia. Colonial Mutual, an Australian insurance and financial firm, acquired State Bank of New South Wales in 1994 and rebranded itself into Colonial Group. Colonial Group was then acquired by the Commonwealth Bank of Australia in the year 2000. First State Fund Managers, together with other asset management businesses in the organisation, were reorganized and rebranded into First State Investments for Global Businesses and Colonial First State Global Asset Management for Australia onshore businesses. In 2019, Mitsubishi UFJ Trust and Banking Corp, a subsidiary of MUFG, bought over First State Investments and rebranded it into First Sentier Investors in the year 2020. The First Sentier Group Limited was established in 2025 as a group holding company to house the different affiliate investment teams, including First Sentier Investors. The group manages over $130 billion of assets currently. As a boutique investment team, First Sentier Investors actually has 4 sub-teams that are Global Listed Infrastructure, Global Property Securities, Asian Fixed Income, and Australian Equities. The solutions under Australian Equities team are not offered in Singapore retail market, so most investors will not typically hear about it. The first Sentier Asian Quality Bond Fund that is covered in this video, without surprise, is managed by the Asian Fixed Income team. There are actually 2 funds covered in this video that have exactly the same fund name, that is First Sentier Asian Quality Bond Fund. One is a Singapore unit trust version that doesn't run its own portfolio, but instead invests into the other that is an Irish ICVC version. In mutual fund jargon, we normally call the Irish fund as the master fund and the Singapore fund as the feeder fund. This works a bit like a Russian doll, with the Singapore fund like an outer shell designed for Singapore investors. The Master Fund is a sub-fund under the First Sentier's Investors Global Umbrella Fund plc fund family. This fund family is set up as an Irish ICVC company structure and is UCITS qualified. The fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. The feeder fund, on the other hand, is a sub-fund under the First Sentier Investors Global Growth Funds fund family. This fund family is set up as a Singapore Umbrella Unit Trust structure. The fund is registered as a MAS authorized scheme, which means it is also suitable for retail investors. Now, since both funds are available to retail investors, this may cause some confusions when trying to figure out which fund and which share classes to go for. We will try to address this when we go through the different share classes later. The First Sentier Investors website is quite interesting in the way it presents the investment team in a dedicated web page and then provide the fund-specific information for all the funds managed by the team, market insight, the team's investment philosophy and approach, and details on the team members, all within the same web page. While this makes the web page extremely long to navigate, I quite like this team-focused approach and find it helps investors understand better how the fund is managed. Here is a snapshot of the header of the Asian Fixed Income Team webpage and the investment team member names and photos towards the bottom of the webpage. The fund webpage and fact sheet doesn't specify any exact manager names, so it seems as if the fund is managed on a team effort basis. Morningstar, however, does provide specific names as shown here, where we can see the fund has actually gone through quite a number of manager changes over the years. The fund is currently co-managed by Nigel Fu since 2013 and Fiona Kwok since 2021. Having Nigel as the fund manager for over a decade at least ensures decent stability in the manager's style for the fund. The detailed bios of the team members can be found back in the Asian Fixed Income Team webpage. Nigel is the head of the team and the lead portfolio manager for the fund. He has extensive Asian fixed income experience and joined the firm in 2010. Fiona also has over a decade of experience in Asian and global fixed income and joined the team in 2021. Let's go through the strategy of the master fund that is the Irish version of the first Sentier Asian Quality Bond Fund. The fund webpage provides a long strategy overview that contains the investment objective and some of the investment guidelines. The first part is similar to that provided in the fund fact sheet, while the second part looks available only in the fund webpage. The investment objective of the fund is straightforward. That is to achieve long-term returns through a diversified portfolio of bonds. This is on total return basis, and there are no specific requirements to generate high income or prioritize income over capital growth. The fund invests primarily, or more specifically at least 70% in investment-grade bonds. These are either rated by the usual recognized rating agencies or determined by the fund's internal rating process if they are unrated bonds. The fund also invests primarily, or more specifically at least 70% in Asia, as defined by the location of the issuer's registration or primary business operations. The additional part indicates that the fund may also invest up to 30% in preferred bonds and contingent convertible or COCO bonds. The fund prospectus provides more information on additional investment restrictions. The fund can invest max 30% in China bonds and max 10% in sovereign issuers that are below investment grade rated. The fund also runs ESG exclusion screenings in the bond selection process for various ESG related considerations. Last but not least, the fund also will not use derivatives for investment purposes. Bonds invested are mainly in US dollars or other major currencies, so it is not expected for the fund to take local currency exposures or have FX as a performance attribution factor. Beyond that, the fund runs an active strategy and is not limited in country or sector exposures. The fund has a defined benchmark, that is the JP Morgan JACI or JACI Investment Grade Index, which represents the liquid investment grade Asia ex-Japan US dollar bond market. It is mentioned though that the fund is not constrained by the benchmark, and the benchmark is not set as a target to outperform. That being said, investors would expect the fund to outperform the benchmark in the long run. Otherwise, it would make more sense to go with a passive ETF tracking the benchmark instead. There are no more strategy information in the fund prospectus, so let's go back to the team and fund webpage. The team considers this fund as a credit strategy, whereby they aim to provide through a high-quality diversified bond portfolio a stable return solution with low to moderate volatility that can provide steady income to investors as well. From the broader investment philosophy and approach of the team, we can also gather that the fund's investment process combines top-down macro assessment with fundamental bottom-up research and credit selection. There seems to be quite a lot of emphasis on the flexibility and ability to act swiftly when needed. Though as investors, we will only be able to get a feel of this in the fund's performance, especially how the fund delivers during sudden changes in markets. Last but not least, with regards to the Singapore version of the fund, there is nothing different in terms of the strategy description from the master fund, and it clearly states the Singapore version will basically invest into the Irish version of the fund. The only notable point is that the Singapore version of the fund is base currency in Sing dollars, and its performance should reflect the Sing dollars hedge returns of the original portfolio based in US dollars. The first Sentier Asian Quality Bond Fund was incepted in 2003 for its Irish version, so that gives the fund a good 20 plus years of track record. Fund AUM is about 1.1 billion US dollars, which is actually not large considering its long track record. This may be either the fund's performance hasn't been attractive enough, or the fund hasn't been marketed actively enough. The Singapore feeder version was incepted only in 2016, although that still gives it a decent 10 years of track record. The fund AUM is very small though, at only 4 million Sing dollars, which suggests it hasn't really been a compelling solution for Singapore retail investors over the years. The very small AUM also leads to the problem of very high costs in maintaining the fund, which we will go through later in the share classes section. Portfolio information of the fund is only available in the fund fact sheet. It is good that the breakdown data provides the numbers for the index as well, so we can easily see the differences between the fund and the benchmark index, that is the JP Morgan Jackie Investment Grade Index. Looking at geographic breakdown, it is clear the fund portfolio looks quite different compared to the index. This is partly because the index has Asia ex-Japan exposure, while the fund has the flexibility to invest in the whole Asia Pacific and beyond. As a result, we can see the fund has 9.6% Australia, 4.6% Japan, 4.4% USA, and 3.4% UK, while the index has nearly no exposures in these countries. Within Asia, there are also significant differences as well. For example, the fund compared to the index has notably lower exposures in China and South Korea, while notably higher exposures in Malaysia. Having a visibly different portfolio construct is good in the sense that the fund is managed actively, although this needs to translate to good performance, which we will go through later. Sector breakdown is a bit more vague, as it basically shows only government versus corporates. The fund is currently about evenly split, with 47% corporates and 53% treasury plus government related, while the index is about 1/3 corporates and 2/3 government related. Credit rating breakdown is provided without index data. While the fund is allowed to hold up to 30% in non-investment grade exposures, it currently has less than 5% in such bonds. The fund does have nearly 60% in BBB exposures that are the lowest rating within the investment grade range, resulting in an average credit rating of single A-. This is quite common for active bond funds, as lower credit rated bonds tend to provide higher yields, translating to better returns for the fund, as long as the fund can manage the credit risk well. The fund fact sheet provides top 10 issuers list that contains primarily sovereign countries plus a few corporates. The portfolio seems quite well diversified with over 170 holdings. Portfolio yield to maturity is slightly over 5%, so we would expect the fund to be able to generate over 4% of distribution yield. Weighted modified duration is almost 6, which looks a bit high, possibly due to exposures in longer maturity sovereign bonds, and may be a concern for investors who are worried about interest rate risk. This is evidenced in the additional data from Morningstar that shows majority of the government bonds having duration of 10 years or more. As the two first Sentier Asian quality bond funds have different domiciles and are catered to different investors, there are differences in the share classes offered. Let's go through the Irish master version first. The retail share class is denoted by alphabet I, which is less commonly seen as it is usually intended for institutional share classes. The base currency of the fund is US dollars, and for US dollars, it comes with accumulation and monthly distribution denoted with M share classes. The fund also comes available in various other currency classes, although there is no Sing dollar retail share class for this fund. The retail I share class has a management fee of 1%. Adding other expenses gives a total expense ratio or TER of 1.05%. Next is the Singapore feeder version. Given this is a Singapore domiciled vehicle intended for retail market, First Sentier Investors has kept it really simple here by offering just one share class, that is the Retail A in Sing dollars with quarterly distribution denoted with Q. It is important to note that this fund is base currency in Sing dollars and has the US dollar portfolio of the master fund hedged to Sing dollars. So this basically gives a Sing dollar hedge performance of the master fund. This is different from, for example, the FSSA Dividend Advantage Fund that has a Sing dollar unhedged performance of the US dollar portfolio of FSSA Asian Equity Plus Fund. The Retail A share class has the management fee of 1%. Here, however, we can see the problem of having a very small AUM. In this case, the TER is actually a very high 2.14%. The reason is because there are fixed costs in other expenses that calculates to a high percentage when divided by a small AUM. This unfortunately makes this fund completely not worth considering because investors have to pay this really high TER simply due to the small AUM of the fund. Sing dollar investors can, however, try to find distributors that offer the III semi-annual distributing Sing dollar hedge share class in the Irish master version, assuming the minimum investment requirement is met or waived. This share class also has a much lower TER of just 0.36%. Distributors are allowed to charge up to 5% subscription fee for the Irish version and 4% subscription fee for the Singapore version, although I think anything more than 2% for mutual funds is excessive. The First Sentier Asian Quality Bond Fund has distribution share classes, but they come with different distribution frequencies. Historical distribution data can also be found in the First Sentier Investors website in a separate dividends webpage, where investors can filter by specific funds and year ranges. There are also dividend disclosure tables with more details on the distributions that we will take a look as well. From the data provided, we can see that the distribution amounts for both the Irish and Singapore versions are not fixed, but tends to stay quite similar over the distribution periods. The reason for this is because the fund is trying to provide a stable, smoothened distribution yield percentage over time. As seen in the dividend disclosure table, the Irish version of I US dollar class has the same 0.46% distribution per month for the past year, translating to about 5.5% annual distribution yield currently. The fund is free to adjust this yield percentage though, as it deems reasonable to meet its investment objectives. 5.5% is, however, notably higher than the underlying portfolio yield net of fees, that is around 2.5% to 2.7% as per the table. As a result, the fund needs to use capital or capital gains to cover about 40% of the distribution payouts. As a result, we can see in this total return versus NAV Morningstar chart that the I distributing US dollar class makes no effort to grow the capital over time, as the NAV stays in a range consistently while all the returns are paid out as distributions. Investors who don't need the income should really go for the accumulation share class instead to achieve better long-term compounding growth. The Singapore version has a similar stable, smoothened distribution yield percentage policy, but in this case pays out 1% quarterly, which calculates to about 4% annually. While the distribution proportions are missing in this table, we can take reference from the Master Funds table and note that this 4% distribution yield is still higher than the underlying portfolio yield of around 2.5% to 2.7%. So some capital or capital gains are still being used for distribution payout here. The total return versus NAV chart of the Singapore A distributing Sing dollar class looks similar though. This is because while the distribution yield is lower at 4%, the TER of the Singapore feeder is significantly higher, and therefore corrodes the NAV more, resulting in a weaker total return. The first Sentier Asian Quality Bond Fund only provides performance table across various time periods. The good thing though is that it includes benchmark data as well for investors to make comparisons easily. Based on the table shown here, the fund looks to have underperformed the benchmark index across all time periods. While I mentioned earlier that the fund's investment strategy and the benchmark index have slightly different exposures, we would inevitably expect the fund to be able to make better active decisions to generate better returns than the benchmark. So this data looks rather disappointing. While Morningstar doesn't provide the benchmark index data, we can take a quick look at the fund's calendar year returns versus its Morningstar category peers, as shown here. Based on the 10-year data here, it looks clear that the fund tends to do better in poor market conditions by having less downside than most peers in the negative calendar years. On the other hand, the fund has noticeably underperformed more relative to peers since 2024 to date. Let's run some performance comparisons. Here is a Morningstar chart comparing the fund with iShares JP Morgan US Dollars Asia Credit Bond ETF or N6M. This ETF is listed in Singapore and is probably the closest match to the fund strategy as it invests in both sovereigns and corporates, as well as having about 20% high yield exposures. The ETF doesn't have Japan and Australia exposures though, similar to the benchmark index of the fund. Here, we can see the ETF, since incepting in 2011, delivered a significant outperformance versus the fund, which probably makes investors wonder why not just go for the ETF instead. If I were to nitpick, the fund actually performed quite similar to the ETF from 2017 to 2023, so the underperformances were before and after this period. However, performing similar is also not good enough, as we are expecting an active fund to do better than a passive ETF tracking the market. I mentioned earlier that the fund underperformed peers since 2024 to date. The same can be seen in this chart where the ETF gradually did better since the start of 2024. While the fund may advocate a more risk-cautious approach in its portfolio, investors ultimately will look at returns at the end of the day, and the track record of the fund is definitely not attractive currently. The same ETF can also be traded in Sing dollars, giving a Sing dollars unhedged performance of its US dollars portfolio. We can therefore compare it with the Singapore feeder version of First Sentier Asian Quality Bond Fund as well. As seen in this chart, the underperformance of the fund since 2024, further dragged down by a high TER, results in an even bigger gap between the fund and the ETF returns in Sing dollars terms. It would therefore be quite clear for Sing dollar investors here on which solution to go for. Interestingly, when putting the First Sentier Asian Quality Bond Fund alongside some of the popular competitor funds in the market in this 10-year chart, the fund doesn't look so bad. In fact, its returns place it in the middle of the group, and the iShares ETF actually managed to outperform all the active funds in this period, suggesting active managers have had some tough times in this market, especially in the past 2 years. Within this group, only Schroder Asian Bond Total Return Fund stood out with a good return, with a much lower volatility and drawdowns. Going back to the since 2024 till date chart gives a different picture though. We can see the funds are kind of split into two groups with a clear gap in between, with First Sentier, Fidelity and Schroder in the weaker performing group. There is a clear urgency needed for First Sentier to improve its returns. Otherwise, investors will simply go for the many other more attractive funds or the ETF instead. With that, let's summarize our findings. First Sentier Investors has its roots from Australia and has been investing in Asia markets for a decently long time. While perhaps not as well known as FSSA, another boutique Asian equity specialist team in the group, it is reputable for its Asian fixed income capabilities among other asset classes. The First Sentier Asian Quality Bond Fund is a diversified Asia-Pacific investment-grade focused bond solution that invests in both sovereigns and corporates. The investment team places a high emphasis on seeking high-quality bonds and provides stability for both income and returns on long-term basis. While the fund is not constrained by its defined benchmark, it does exhibit an active portfolio that has notable differences in geographic and sector exposures versus the benchmark. There is a Singapore feeder fund that goes by the same name and is base currency in Sing dollars with a Sing dollars hedge performance. The feeder fund, however, doesn't have significant features to serve a meaningful purpose. It would be more practical for the Irish Master Fund to just create a Sing dollar share class accordingly. Consequently, the AUM of the feeder fund is too small, at just 4 million Sing dollars. This leads to a very high and unsustainable TER that in turn reduces the net return to investors significantly. The distribution share classes of the fund have yields that are much higher than the underlying portfolio yield. As a result, all the returns have been paid out as distributions, and there seems to be no effort to grow the capital for the distribution share classes. Performance of the fund has been underwhelming in the past decade and has been average among peers. The fund has exhibited lower drawdowns in bad market years, but lagged behind in good market years, suggesting decent risk management but not able to capture upside well. In particular, the fund underperformed more since 2024, which is a worrying concern. Investors can easily go for a passive ETF covering the market to get a much better return. In conclusion, despite the active management efforts seen in the fund portfolio, the result is an average performing fund that has managed downside risk decently but not able to capture enough market upside. Until the fund can achieve better returns, this is unfortunately not an attractive solution to consider currently. The Singapore feeder, given its very small AUM, also serves no meaningful purpose and completely not worth considering for Sing dollar investors. This concludes my absolutely biased comments on the first Sentier Asian Quality Bond Fund, and I hope it will help in your investment journey. May we all grow wiser and prosper.